So, Sunday's class, we are doing the chapter Futures. We'll complete the futures in today's class with few more problems to be covered. Then we'll start with the next slot. That is the last slot in the derivatives relating to interest rate derivatives. We'll be discussing the concepts like forward rate agreements, interest rate options, interest rate futures, interest rate swaps, currency swaps, etc. Please. So I have also given you some extra problems which we'll be doing in the class, which is there in the recent RTPs. So concept is not new. Just to reaffirm what has been done, we'll do those few extra sums also. Once we complete all this within 20th, then the last 10 days we'll complete the chapter mutual funds, equity valuation, and then mergers and acquisitions. So what will be pending is the Greeks will be doing in the first week of April. Okay, now. That is, we are discussing about the futures. Stop talking, please. We are discussing about futures in which the last slot called as hedging through futures is being done. I will summarize from that particular stage where we have to write some notes for that beta hedging, the problem which we completed in the previous class regarding the target beta, etc. Once we complete the notes, we'll do few more problems in the hedging through futures. I'm hearing voices. Stop talking, please. We have seen that a person who has taken a long position or buy position in cash market is afraid of fall in prices on the future date when he goes to sell it. Or a person who has taken a short position or sell position in cash market is afraid of increase in prices at the time of buying it later. So to protect against the price movement, they can hedge their position in the futures market. A person who is long in the cash market should go short in the futures market. If you have bought in the share market, you should sell in the futures market. If you are sold in the cash market, we should go for a buy futures in the futures market. By taking this position, there is going to be an offsetting effect. For example, I have purchased a share in the share market. When the share price, and I have sold the shares in the futures market. When the share price increases, I will make a gain in the cash market. At the same time, when the share price increases, futures price also will increase. I had to give a futures buy at a higher price. I will be having a loss in the futures market and vice versa. So gain in one market will be offset by the loss in other market. This is what we call as hedging through futures. We saw that when I am long in TCS shares, I should go for short TCS futures. If I am long Reliance shares, I should go short Reliance futures. But all securities need not have futures contract traded in the futures exchange. Then we have to go for the index hedging or beta hedging concept. Not even single security. If I hold a portfolio also, when I want to hedge a portfolio, I have to only go for the index hedging or beta hedging. Where in the futures market, I'll take a position in the index, namely Nifty futures buy or Nifty futures sell, etc. Question arises, the share price movement and the index futures movement may not be correlated. How we can link both of them? By using the concept called as beta. Then we discuss that how much should be the futures market value. It should be beta times the cash market value. It should be the futures market value. For example, it is beta is 2 times, means when the index changes by 1%, the share value changes by 2%. So to tackle a 2% change in share value, I should not hold 1 time the cash market value, I should be holding 2 times the cash market value is the logic we have discussed. When we continue further, we also saw that Sometimes when I hedge a portfolio, I don't want to reduce my risk to zero. I can have a partial risk reduction. In the last sum we did 1.19, we want to make it to 0.8. In that case, no need to hedge the full beta, hedge only the beta minus target beta. Even if you want to increase the risk to a target level, possible by taking a similar position in the futures market. These are all the issues we discuss in the hedging through futures. Everybody, I think all able to recollect or not? Now, I think I have to write small notes regarding the beta hedging or hedging through futures, and then quickly complete the remaining slot. Okay, I think last time we completed that particular portfolio hedging problem. Question number 31 has been last completed. Yes or no? Now, below that, let us have a notes in this regard and then proceed further. Now, please stop talking. Write down notes. Point number 1. Point number 1. Beta represents change in security return. Beta represents change in security return in relation to beta represents change in security return in relation to market return. Beta represents change in security return in relation to market return. Continue. For example, in question 28, the beta of MTNL is, for example, in question 28, the beta of MTNL is, tell me what it is. Beta of MTNL is what? 1.2. This means when the Nifty changes by 1%, this means when the Nifty changes by 1%, index is Nifty, when Nifty changes by 1%, MTNL changes by 1.2%. MTNL changes by 1.2%. Hence, when Nifty changes by 10%, continue. Hence, when Nifty changes by 10%, MTNL changes by 12%. MTNL changes by 12%. Can I proceed now? Now, point number 1 or 2? 2. The contract value in the futures market, is equal to beta times. The contract value in the futures market is equal to what? Beta into cash market value. Point number 2, the contract value in the futures market is equal to beta into cash market value. Is equal to beta into cash market value. In that problem, Shyam had 10 lakhs buy position of MTNL. In that problem, Shyam had 10 lakhs buy position of MTNL. 10 lakhs buy position of MTNL in what? Cash market. 10 lakhs buy position of MTNL in cash market. If he takes the position with same value if it takes the position with same value in the futures market, if it takes the position with same value in the futures market, the hedging will not be complete. If it takes the position with same value in the futures market, the hedging will not be complete. Are you understanding and writing or not? No. So if we take the same position in the future market, hedging will not be complete. Right on? Because hedging will not be complete because hedging will not be complete because to tackle a 1.2% change, to tackle 1.2% change in the cash market, to tackle 1.2% change in that cash market with a 1% change in Nifty, to tackle 1.2% change in the cash market with 1% change in the Nifty, we should take a higher position value. We should take a higher position value. We should take a higher position value in futures market. We should take a higher position value in futures market. We should take a higher position value in futures market. That is 1.2 into 10 lakhs. That is 1.2 into 10 lakhs is equal to how much? 12 lakhs is equal to 12 lakhs. Continue. For example, if Nifty falls by 10%, for example, if Nifty falls by 10%, the gain in futures market is, and I am having a future sell in the problem, yes or no? If the Nifty falls by 10%, the gain in futures market is 10% into 12 lakhs. The gain in futures market is 10% into 12 lakhs. What is the gain here? 1,20,000. Full stop. In cash market, MTNL will drop by. In cash market, MTNL will drop by. MTNL will drop by 10% or 12%? 12%. MTNL will drop by 12%. And the loss in cash market will be, I am now having 10 lakhs MTNL not. Loss in the cash market will be how much? 10 lakhs into 12% is equal to 1,20,000. The loss in cash market will be 10 lakhs into 12% is equal to 1,20,000. Resulting in what? Perfect hedge. Resulting in perfect hedge. Can I proceed or not? Next. Point number 2 or 3 or 4? Point number 3. When we multiply the cash market value with beta, we are trying to do a complete hedge. When we multiply the cash market value with beta, we are trying to do a complete hedge to reduce the beta to. To reduce the beta to what? 0. We are trying to do a complete hedge to reduce the beta to 0. Can I proceed or not? Cash, that is futures market value is equal to beta minus 0. I want to make the beta to what? 0. Beta minus 0 into what? Cash market value. Beta times cash market value has been elaborated as what? Beta minus 0 into cash market value. Suppose, continue, suppose we want to do partial hedging. Suppose we want to do partial hedging as is done in question number 31. Suppose we want to do partial hedging as is done in question number 31. Our beta should not be reduced to 0. Our beta should not be reduced to 0. In such case, future market value is equal to what? Beta minus target beta. Futures market value is equal to beta minus target beta into cash market value. Beta minus target beta into cash market value. Beta minus target beta into cash market value. Respond yes or no? I don't. In question 31, we wanted to reduce. In question 31, we wanted to reduce the portfolio beta from 1.19 to, we wanted to reduce the portfolio beta from 1.19 to what? 0.8. We wanted to reduce the portfolio beta from 1.19 to 0.8. Hence, the futures market value was 1.19 minus 0.8. Hence the futures market value was 1.19 minus 0.8 into 1300 lakhs. The cash market value into 1300 lakhs. Everybody yes or no? Now, last point. Point number 4. Can we increase the beta? Point number 4. Can we increase the beta through futures market? Can we increase the beta through futures market? Can we increase the beta through futures market? Answer the question yes or no? Yes. Write down yes. This can be done by taking same position in futures market also. This can be done by taking same position in futures market also. This can be done by taking same position in futures market also. By taking same position in futures market also. Everybody understanding this or not? Due to this, we will either have gain in both markets. Due to this, we will either have gain in both markets or what? Loss in both markets. Due to this, we will either have gain in both markets or loss in both markets, thereby increasing risk. You can either have gain in both markets or loss in both markets, thereby increasing risk. Everybody respond. Are you all following or not? No. With this, we have completed the notes for the beta hedging. I gave you the following notes. When you don't have the corresponding futures contract, go for the Nifty. Hedge using the beta. Reason has been given through the MTNL example. I can hedge fully or what? Partially. Partially means beta minus target beta should be hedged. Where I don't reduce the risk to 0, I reduce my risk to what? 0.8 in that case. Can I use futures to increase my beta? Yes, by taking similar position is what ultimately learned. Innappa right or not? Now, next. Let me discuss one more concept quickly. Now, V is equal to beta square sigma m square sigma EI square. Have you heard this anywhere else? Yes, good morning, friends. This formula is new to us, already discussed. New already discussed. Where we discussed, yeah. Short portfolio, which area? Sharp single index model. Now, this is a variance of security. It is called as what? Variance of security. Why the security varies? Because the market varies. Is or not? The market varies, it should also vary. It varies due to some other reason. What the reason? I don't know. Which we call as what? Error coefficient. We discuss elaborately or not? Now, this is called as what? Risk. We call as what risk here? Total risk. We call as what risk? Total risk. This is called as what? Systematic risk. It is called as what? Unsystematic risk. Everybody, yes or no? Now, see. We have seen that by diversifying, I can eliminate unsystematic risk. We invest in the entire market. What is eliminated? Unsystematic risk can be eliminated. So unsystematic risk, what is the way for avoiding unsystematic risk? Through diversification. There everybody said that systematic risk cannot be avoided. So you should always ask a risk premium for what? Systematic risk. That is why K is equal to what? RF plus beta into RM minus RF. Yes or no? After the derivatives, advent of derivatives, people said, don't think that systematic risk cannot be what? Avoided. By beta hedging, the beta can be reduced to zero. Yes or no? No. By diversifying, I can avoid what? Unsystematic risk. And through what? Beta hedging. How we saw in the futures market now? Yes or no? No. When you go for beta times a cash market value, I reduce my, say, beta to what? Zero. So by beta hedging, the beta can be reduced to whatever number I want. Can even be reduced to what? Zero. So through beta hedging, I eliminate what? Systematic risk. Through diversification, I eliminate what? Unsystematic risk. Innappa, yes or no? No. Somebody says, total risk of a company is, say, some number. Okay. And after beta hedging, what is a risk left out? Tell me. After doing the beta hedging, what the risk left out risk is what? Unsystematic risk. That is a question that is going to be asked in the next problem. Are you following what I am saying? No. So when I do a beta hedging using what market? Futures market. I am long in cash market. I go for what? Beta times cash market value in what? Futures market. I said that the beta is not perfect. Beta is not what? Perfect. Because the cash market changes by, that is the futures, the index changes by 10%. It need not be changing by what? 12%. Sometimes may even drop by 11% or 10%. Possible or not? No. Why it is imperfect? The imperfect only called as what? Unsystematic risk. Are you following what I am saying? So, why the beta is not true? The beta is not true because the regression line is not a perfect line. It is a line of best fit. There can be points lying above the line or below the line. If you are able to recollect, in that case, the beta hedging is not perfect because of what? Unsystematic risk. So what they say is, hedge using the beta to eliminate what? Systematic risk. Because when the market changes, you get to some extent what? Influence. It is not perfect influence, no problem at all. There's an error coefficient or not that you can avoid by investing in what? More securities across the board, thereby also trying to reduce what? The unsystematic risk. Everybody follow what I am saying? So this is what we call as the eliminating of systematic risk using the beta hedging. Take question number 27. Take question number 27. Beta of Sterlite is 1.3. Total risk of Sterlite is 9. What is 9? Variance. The daily standard deviation of Nifty is 1.6. Once complete hedging is done, how much risk is left with? Now, people may, when they look at the question, may get confused. Once complete hedging is done, How much risk is what? Left with, na? The question is an oxymoron, anomaly, yes or no? Anomaly means what? One sun is gone. How much light is left with means what? Sun gone, light is gone, yes or no? Like that. That is something called as anomaly, yes or no? Same way, please. Shh. Once complete hedging is done, hedging is what? Risk reduction. Once complete hedging is done, how much risk is what? Left with? Apni question arises na? When complete hedging is done, my beta of 1.19 can be reduced to what? 0. Yes or no? When the beta is made as 0, the risk left with is 0. True or false? False. Because what is left with is what? Unsystematic. Is what the question tries to answer. Everybody, yes or no? Now, see, all links here. To know this, we should know about the sharp single index model. Yes or no? Everything is what? Interrelated. Can I proceed? Now, can we start doing the problem? 1 minute answer. Can I proceed? Write down question number 27. Question number 27. Okay, let's do it together. V is equal to, please. V is equal to, forgot the formula. What the formula? Beta square sigma m square plus sigma ei square. For understanding, let's try. This is called as what? Total risk. This is called as total risk. This term is called as what risk? Systematic risk. And this is called as what? Unsystematic risk. Don't get annoyed. Tell me the answer. Systematic risk by total risk is called as what? Systematic risk divided by total risk is called as what? Coefficient of determination. Discussed in short English model or not? How much of the risk can be answered, determined, explained away with the help of what? Market change. And other part is what? Could not be determined. Remember or not? No. Go home and revise. Can I proceed? Now, what is the total risk here? 9 is equal to, what is the beta of the sterlite? 1.3 squared into what is standard deviation of the market? 1.6 squared. So 1.3 squared into 1.6 squared, beta square sigma say m square plus sigma ei square. Sigma ei square. Enough right or not? Now, continue. Sigma ei squared is equal to 9 minus, can tell me the multiply number? 1.3 into 1.3 into 1.6 into 1.6, what number? 4.3264. 4.3264. What is the number here? 4.6736. 4.6736. Now, this is what risk? Unsystematic risk. After complete hedging using future, this much say risk is what? Left, unhedged. Yes or no? Write down. Next. Once, continue. Once complete hedging is done, once complete hedging is done, the leftover risk is, once complete hedging is done, the leftover risk is how much? 4.6736. Once complete hedging is done, the leftover risk is 4.6736. The leftover risk is 4.6736. 4.6736. Everybody, are you understanding or not? Write down notes. Write down notes. Point number 1. Risk of a security can be classified into two types. Risk of a security can be classified into two types. Risk of a security can be classified into two types. Branch it into two. Name the two types of risk. Systematic risk and negative is what? Unsystematic risk. Systematic risk, unsystematic risk. Systematic risk, put the down and right. The risk that can be explained. the risk that can be explained, the risk that can be explained with the help of beta, the risk that can be explained with the help of beta, the risk that can be explained with the help of beta. Everybody has known why the market changed by 12%? Because the market changed by what? 10%. I can explain with the help of what? Beta. Risk that can be explained with the help of beta. Unsystematic, right? Risk that is random. Risk that is random or could not be explained. Risk that is random or could not be explained. That is company specific. Risk that is random, could not be explained. That is company specific. Could not be explained. That is company specific. Company specific. Why Sahara Group share failure? Because anything happened in market? No. It happened due to what? Litigation against a company. Anybody know? It is called as what? The specific risk. Can I pass it? Now, write down. First part. Put it down again, right? Systematic risk can be reduced. Systematic risk can be reduced. Systematic risk can be reduced through what? Beta hedging. Systematic risk can be reduced through beta hedging. Systematic risk can be reduced through beta hedging. Now we are disputing CAPM itself. So now, CAPM said what? We cannot reduce what? Systematic risk. It cannot be diversified away. For that only having what? A beta hedging. Systematic risk can be reduced through beta hedging. Go to second branch. Unsystematic risk can be reduced through, please fill out the blanks, can be reduced through what? Diversification. Unsystematic risk can be reduced through diversification. Unsystematic risk can be reduced through diversification. Unsystematic risk can be reduced through diversification. Can be reduced through diversification. Everybody understanding it or not? Now, point number 1 or 2? Point number 2. In this problem, the total risk before beta hedging was, the total risk before beta hedging was what? 9. The total risk before beta hedging was 9. In this problem, the total risk before beta hedging was 9. I will find out now. By doing beta hedging, the beta is reduced to, the beta is reduced to what? 0. By doing beta hedging, the beta is reduced to 0. The beta is reduced to 0. Hence, the leftover risk is what? Unsystematic risk. Hence, the leftover risk is unsystematic risk. Which can be hedged through what? Diversification. The leftover risk is unsystematic risk, which can be hedged through diversification. Everybody, are you understanding it or not? Now, with this we complete the solution to question number 27. Everybody respond. Are you having the full clarity here? Now, see, we are discussing very interesting and important things. Disputing the portfolio theory. Say, yes or no? No. Portfolio said that beta is systematic, cannot be what? Avoided. When the market reacts, it should also what? Move up and down along with what? Market. The answer to that is very simple. You take an opposite position, market moves you up. Okay, if you take an opposite position, also moves you what? Down. Then the stability will be what? Obtained. This is taken through what? The futures. So no, in that case, I can reduce the systematic risk to 0 or even to what? A target level which I want. Have been discussed with the beta hedging. And the leftover is what? Unsystematic risk, which already sharp and all set can be diversified away into more securities. Everybody is or no? Literally, what they are trying to say is, through hedging, one can eliminate what? The entire risk also is what they are trying to communicate. Everybody, are you following or not? Now, next. Before I go to the next question, that is question number 30. It is a past examination problem for 5 marks. It is a 5 mark first compulsory question in examination. I want to tell you one concept and then go for this particular problem. Nothing great, just 1 minute concept. Can I proceed or not? Now, see. See, we are having two markets. What two markets? Cash market and then what? Futures market. If I am long here, I am what? Short. If I am short, I am what? Long. The reason is, when I am long, I will gain through increase in prices. When I am short, I am going to lose through what? Increase in prices. And when the decrease in price, I'll be losing, I'll be what? Gaining. The main aim of taking opposite position is very simple. If I'm a holder, so suppose I'm a writer, then also become what? Holder. I'm negating my liability. It's no. Same logic. If I take opposite position, what happens is I'm bringing what? Stability into my portfolio. Ange write account, hold the delta shares we had in the binomial model or not. Nothing but what? Taking a opposite position where the risk can be what? Reduced. Same logic here also. I am long in cash market, short in what? Futures market. Means the price behavior affects differently both the positions, thereby bringing a stability into my portfolio. Now, my question is, cash market, I am long MTEL. MTEL shares. Okay. In futures market, can I short MTL futures? No. Because there is no futures contract for what? MTL shares. Hence I go for what? The index or what? Nifty. Yes or no? No. So the MTL cash market price movement and the index movement are same or different? Different. They are same or different? Different. So then what happens is we are linking these two price movements with help of what? Beta. When I say beta is 1.2, very simple. When the index moves by what? 1%. The MTL moves by what? 1.2%. Through using beta, I try to achieve some perfection in my hedging. Yes or no? Otherwise, if I 10 lakhs here, if I take the same 10 lakhs here, I will not be hedging properly because this 10 lakhs movement and this 10 lakh movement is not what? Same. This is 1.2 times more movement. Yes or no? In that case, I will take how much portion? 12 lakhs portion to hedge my portfolio perfectly. Everybody understood or not? Yeah. Now, I'll ask the next question. What are the two markets? Cash market, futures market. Okay. Suppose I am long in cash market, short in what? Futures. I am short in cash market, long in futures. I am doing hedging or not? No. Cash market, I am long TCS shares. What shares here? TCS shares. I will go for what futures? It is available, better to go for what? TCS futures. In the paisa no. That means that when TCS shares move up and down, futures also what? Move up and down. In the parade or not? And then if I have 10 lakhs in cash market, I'll take how much portion in futures market? 10 lakh. I am not hedging through an index. I am hedging through what? The same share contract only. So we believe that the beta is 1. Yes or no? You know, the TCS moves by 1%, the futures also should move by what? 1%. TCS drops by 1%, futures also should drop by what? 1%. Everybody understanding or not? I said, this may not always happen. I said or not? Last class notes, I said it does not always happen because cash market is a different market and future market is what? Different market. Even NSE, BSE prices different sometimes. In that case, when the cash market TCS share crashes by 5%, there's no guarantee that the futures price also will crash by what? 5%. It may be late to react or beyond the futures period, the shock may not be there. Everybody follow what I'm saying? But what I can say is, cash market price movement of TCS shares need not be what? The same as the price movement of futures in TCS shares. Everybody understanding? Yes, now, in that case, what they say is, this is a price, this is a price. This is going to have a standard deviation. I call us what? Sigma S means what? Standard deviation of the security prices. Futures also prices only of TCS shares, or no? I call as sigma F what? Standard deviation of what price are? Future price. That's a standard deviation of the spot price. The standard deviation of what? Future price. Both should be same or need not be same or need not be same. Yes or no? Now, what I do is standard deviation of the spot price divided by what? Standard deviation of the future price tells you how they are moving together. Yes or no? Now, and we should also multiply by what? Correlation of spot price and what? Future price. I'll get a number similar to beta. Namaskaram to what? Beta. I don't want to call it as beta because beta links what? The market with the share. Now this is a number which is ditto same as what? Beta, which links what? The futures market with the security. Respond yes or no? Now I can do a beta hedging like this so that futures can be much more accurately hedged. Are you following us? You understand what I am saying? So now TCS share in share market is always constant. The changes are. So the change is measured through a number called as what? Sigma here. Futures TCS price is stagnant. Change. That's called as what? Sigma here. In an ideal world, in what? An ideal world, a perfect world, these two should be same. When the spot price underlying asset change, the contract also should what? Underlying asset change by 1%, contract value should change by what? That is a utopian or what? Ideal world. Everything will be happening as planned. Yes or no? But both are what? Different markets. Market has got different players. They have what? Different perceptions. Everybody, yes or no? In such a case, the sigma S need not be same as what? Sigma F. The change may be different. Yes or no? So, how the MTG share price change and the Nifty change need not be same. There will be what? Different. And you measure the relationship using what? Beta. What is beta? Beta is what? Sigma S by sigma S into correlation of S and M. Is beta calculation or not? Like that. We even calculate beta for what? A share market price and the futures market price. And then doing beta hedging using what? Future. There is much more better way of hedging it. Everybody, yes or no? Now, in that case, sigma S is what? Security standard deviation. Sigma F is what? Futures markets. This is also for same security only, but the futures price is standard deviation. Standard deviation of the spot price by what? Standard deviation of the future price into RSF gives you what? The beta. For example, this number is 1 point. What is number here? 1.2. And then what is 1.2? When future prices moves by 1%, the spot price moves by how much here? 1.2. That's how we explain it. We want to tell other words. When the spot price moves by what? 1.2. The contract price moves only by what? 1. It is not reacting so much to what? The spot price is what you have to understand it. Everybody, are you following what I am saying? In the concept, now, based on this only the next 5 marks problem has been asked. Can I complete that sum or not? Once I complete, I will be having a small notes. In another 10 minutes, remaining 2 sums can be completed before we end up this chapter, futures. Okay, now. Take question number 30. Take question number 30. This question is asked in exam or not? Yes. Again I say, whatever I am discussing are all in syllabus only, but study material does not give anything with so much explanation or concept based. We are discussing background for everything. That only takes some time. These sums can be answered in no time. Can I proceed? Now take question number 30. Yes, switch on or switch off? Yes. A company is long on 10 MT of copper. MT means what? Metric tons. A ton is equal to how many kgs? 1000 kgs. Okay. Now, at 474 rupees per kg spot, and intends to remain so for the ensuing quarter, the standard deviation of changes of the spot and future prices are 4%, 6%. What is 4%? Sigma S, standard deviation of the spot market price. And what is 6%? Sigma F, standard deviation of the futures market price. Having correlation coefficient of 0.75. Normally, futures and spot market correlation is very strong. Anything above 0.5 is what? Good correlation only. It is 0.75. Why correlation is so great? Because both are what? Same asset only. Yes or no? It may be uncorrelated, not so much. Are you following up? No. Next. What is the hedge ratio? What is the hedge ratio? The beta times only we call as what? Hedge ratio. What is the amount of copper futures it should short to achieve the perfect hedge? Is a question. It is an exam question for 5 marks. Okay. We don't even take 5 minutes to answer this question. No. Write on first. Point number 1. Cash market position. Let's do it together. Point number 1. Cash market position. I think question number? Okay, cash market position. Okay. Long or short? Long. How many kgs? 10,000 kgs. Then 10 metric tons means how many kgs here? 10,000 kgs. Long 10,000 kgs of, what the underlying asset? Copper. Long 10,000 kgs of copper at how much per kg? 474 per kg. Long 10,000 kgs of copper at 474 per kg. Today I am holding 10,000 kgs of copper at how much rupees? 474 per kg. I am afraid of going above 474 or below 474 or below. If it becomes 460 or 50, I will be losing so much money from holding this copper. Yes or no? No. Hence I want to go for what hedging? Futures hedging. Can I proceed or not? Next. Beta of spot prices and what? Futures prices. Beta of spot prices and future prices. Beta of spot prices and futures prices. Can you start or not? Now tell me. Beta is equal to, formula is what? Sigma S by sigma F into RSF. Sigma S by sigma F into RSF. Tell me what is standard deviation of the security? 4%. Right, as 4 itself not an issue. 4 divided by what standard deviation of the futures here? 6 into what? 0.75. 4 by 6 into 0.75. Tell me what is the number? 0.50. 0.5. Okay. So beta is 0.5. Can you explain what is 0.5? When futures price changes by 1%, the spot price moves only by what? 0.5. So should I take the same value, less than that, less than that. RL fund because cash market volatility is less. I need not hold so much in the futures market. Respond yes or no. Write down. Next. Point number 2 or 3? 3. Point number 3. Value in futures market is equal to, value in futures market is equal to what? Beta into cash market value. Value in futures market is equal to beta into cash market value. Tell me what is beta? 0.5 into, multiply and tell me what is that here? 474 followed by 4 zeros. Okay. 47 lakh 40,000. 0.7 into 47 lakh 40,000. What amount here? 23 lakh 70,000. That's all. Answer over. 23 lakh 70,000. Yes, 23 lakh 70,000. Everybody following up? Now, tell me what are two questions. One is what? What is the hedge ratio? The hedge ratio is what? 0.5. I don't hedge fully. I had only go for what? 0.5. Yes or no? Hedge ratio is what? 0.5. And next is what? That is the amount of copper future that should be hedged. What is the amount to be hedged here? 23 lakh 70,000. Write down. Next. Conclusion. The hedge ratio should be. The hedge ratio should be. The hedge ratio should be what? 0.5. The hedge ratio should be 0.5. The hedge ratio should be 0.5 and the amount of copper futures and the amount of copper futures is, how much is 23 lakh 70,000 and the amount of copper future is 23 lakh 70,000. The strategy is sell copper futures. The strategy is sell copper futures worth rupees 23 lakh 70,000. Sell copper futures worth rupees 23 lakh 70,000. Sell copper futures worth rupees 23 lakh 70,000. Everybody are you understanding it or not? Now. Okay. Now, with this up to 31 has been completed or not? Now, 32, 33 and 34 are very simple, no new concept. Till now it was long in cash and short in what? Future. If I have short in cash market, what I should do? Long future. So let us do few problems to get used to that and then complete this chapter. Can I proceed? Now, take question number 32. Take question number 32. Doubt appa? Can I proceed? Take question number 32. What, yeah? Oh. Can't you understand this notes, huh? Okay, write down notes. Write down notes. Yaar but doubt?
Said that market changes, if the cash market changes by 0.5%, the future market will change by 1%.
Correct.
Why we are multiplying by 0.5 into what is, sir? We have to multiply to the.
No. I'll say like this. How much futures market value? That is 23 lakh 70,000. Enna kadapar? Yeah, sollupa. What the cash market position? 45 lakhs 40,000. Enna kadapar? Now listen here, please. Solremba, cash market is 47 lakh 40. How much? 23 lakh 70,000 in what? Futures market. Enna right or not? Now, suppose futures market drops by 10%. Drops how much percentage? 10%. What the cash market drop? 5%. Accept or not? Now, 10% on 23 lakh 70 gives you what? 2 lakh 37,000 is a gain. Yes or no? Now, what is 5% of 43 lakh 74,000? 47 lakh 40,000. Same 2 lakh 37,000. Gain is equal to loss. Now, I have told the formula beta times what? Cash market value matters all. Can I proceed now? Take question number 30. Notes up. Write down notes here. Write down notes. Point number 1. Point number 1. When we hedge cash market position with index futures, we use beta. When we hedge cash market position with index futures, we use beta. Because, tell me, why should we use beta? Because what? The cash market change, and the index change are not same. We use beta because the cash market change and index change is not same. And these two changes are linked using what? Beta. And these two changes are linked using beta. Point number 1. Everybody following now? I go from known to unknown. This point number 1 is over or not? Next. Point number 2. If we hedge the TCS shares, with the TCS futures contract, normally we believe that the spot prices and futures prices, vary similarly. Normally we believe that the spot prices and futures prices vary identically. Okay, vary identically. The spot prices and futures prices vary identically because both are prices on TCS shares. Because both are prices on TCS shares. Because both are prices on TCS shares. Both are prices on TCS shares. Did you follow the second point or not? Earlier, the index movement and the share movement need not be same because both are different. Na? In this case, cash and futures market both are what? TCS shares only. So they move identically as a normal assumption. Yes or no? Now, point number 2 or 3? 3. However, the above is not true. However, the above is not true. However, the above is not true. Because, however, the above is not true. Because both are different markets. The above is not true because both are different markets. The change in spot prices, the change in spot prices, in bracket write sigma S. The change in spot prices, in bracket write what? Sigma S need not be the same as the change in spot prices sigma S need not be the same as what? Change in futures price. The change in spot prices need not be same as the change in futures price. Bracket write what? Sigma F. Bracket sigma F. In such case, we can calculate a beta linking. In such case, we can calculate a beta linking. A beta linking what? Cash market and futures market price. In such case, we can calculate a beta linking cash market and futures market price. Cash market and futures market price. Which is done as follows. Please write the formula. Beta is equal to, everybody tell me what is the formula? Beta is equal to sigma S divided by sigma F into RSF. Sigma F by sigma F into RSF. Everybody, are you understanding it or not? Now, with this we complete question number 30. Question number 30. Okay, 31 already done. Take question number 32 now. Please let's do it together quickly. Now, Hari sells 1000 shares of HPCL at 190. Obtains a complete hedge by buying 300 Nifties at 972. He closes his position at a closing price on the next day. At this point, HPCL has increased by 5%, Nifty by 4%. What is the overall profit and loss on this set of transaction? Can we do it or not? Now, question number 1, 32. I hope you are reading the question along with me. Now, tell me, Hari has position in how many markets? Everybody? 2 markets. Now let's do it together. Right along with me. Question number 32. About how many markets here? 2 markets. Name the 2 markets. Cash market. Next is what? Futures market. Cash market, futures market. Now, Hari has bought the HPCL share today. Was sold? Sold. He is having what position? Sell position or short position. He sells HPCL. How much rupees today? 190. Tell me, today he will be sleeping peacefully or no peace? Why no peace? Afraid about increase or drop in price? He is afraid about increase in price or decrease in price? Increase. Because tomorrow he has to buy the share and the price increase having a loss. Is or not? He is afraid about the increase. So to protect himself, he goes to what? Futures market. Buy or sell, sir? Buy. He buys what? Nifty. At how much price? 972. He buys Nifty at 972. Tomorrow he comes out of what? Both markets. As he fear, the price has increased or decreased? Increase. Now, when he comes out of cash market, he just buys the HPCL share to close his short portion. When he went to buy, the price was 190, more than 190, more than. It increased by how much percent? How much percent? 5%. Please take the calculator. 190 into 105. 190? 199.5. He buys back at 199.5. Why should he buy? To close his short portion. Yes or no? Now tell me, he is having a profit or loss? Loss. What the loss per share? 9.5 is the loss per share. Into how many shares? 1000 shares. Gives how much rupees here? 9,500. Had he not gone to futures market, he'll be crying for how much rupees? 9,500. That's a loss for him. Respond, yes or no? No. Come to the futures market. He will close the future portion by giving what? A counter sell. He will sell at 972 more than that. Futures price also increase. How much percent? So 972 into 104%. Yellapa? 10.88. 10.88. He is having a gain or loss? Gain. What a profit for him? 38.88. You know how many Nifties? What the profit amount? 11,664. Profit is 11,664. Tell me, his cash market loss has been recorded by what? Futures market gain in margin account. Tell me the overall profit is how much here? 2,164 is the overall gain on the set of transaction. 2164. I want everybody to answer. Everybody have the clarity or not? Now, next. Take question number 33. Take question number 33. Please. Shh. Ever plus. Finish copying, huh? Yes, can I proceed? No. Ever Plus Private Limited, please, shh, has a very strong view that Tata Steel share will go down since steel industry scenario is perceived to be gloomy. It believes that within 1 month, prices of Tata Steel will go down by 20%. Okay, it is 20%. Make a change. It is 20% from the present rupees 150. It sold 10,000 shares of Tata Steel short. Why is the company selling the Tata Steel? Because it is bearish. It is what? Bearish about the market. They feel Tata Steel is going to fall. I can buy it later to make a profit. Okay, hence it sold what? 10,000 Tata Steel shares and wants to hold short portion for a month. Today is 30th September 99. That's the old problem. It wants to square up its position by 31st October 99. To hedge stock index exposure, it wants to use Nifty futures contract. Nifty is say 1200 now. Calculate the number of Nifty futures contract to be purchased by the company and what is the profit profile on 31st October 99 in the following situations. America lifted sanctions which boosted the market sentiments and the Nifty rose to 1,275 and Tata Steel also increased to 154. Nifty reduced 1,150 points and Tata Steel was 135 and the separate point is beta of Tata Steel is 0.8. Now, wherever they use the word Nifty here, we should context and understand to be what? Nifty future. I don't want a spot Nifty price. I want only what? Nifty future price. I'm hedging to the Nifty future. So no, the word Nifty here referred to is always to be understood contextually as what? The Nifty futures. I think you're all able to understand or not? No. Now let us start doing the solution for this particular sum. Tell me first, cash market. He is long or shorter? All of you, cash market, long or shorter? Short. He has sold what company is that? Tata Steel share. How many shares? 10,000 shares. At what price? This is cash market value. Yes or no? Write down. First, point number 1. Let's do it together. I think it is question number 33. Okay. Write down. Point number 1. Cash market position. Point number 1, cash market position. Cash market position. Tell me, this company has sold or purchased or sold? Write down. Sell, that is short. How many shares? 10,000 shares. Of what company? Tata Steel. At how much rupees? 150. Short 10,000 shares of Tata Steel at 150. Short 10,000 shares of Tata Steel at 150. Everybody yes or no? No. When he short in cash market, what should do in futures market? Go long in futures. Yes or no? No. Point number 2 is what? Futures market position. Point number 2, futures market position. Is there a Tata Steel future? I am hedging through Nifty futures or Nifty future. That means normal hedging or beta hedging or beta hedging. Write down. Futures market value is equal to futures market value is equal to fill in the blanks. Beta times the cash market value. Futures market value is equal to beta times the cash market value. Now what is beta? What is the beta? 0.8 into 10,000 into 150 gives you 15 lakhs. That gives you 15 lakhs. How much going to be? 12 lakhs. 12 lakhs. It's going to be what? 12 lakhs. Write down. Buy Nifty futures worth. Futures market portion, continue writing. Buy Nifty futures worth. Tell me, buy Nifty futures worth how much rupees? 12 lakhs. Buy Nifty futures worth 12 lakhs. Buy Nifty futures worth 12 lakhs. Everybody understanding it or not? Now, point number 2 or 3? 3. Number of contracts. Number of contracts. Number of contracts. Now, today the Nifty future is trading at how much rupees? 1,200. First write number of Nifty. Number of Nifties is, I think 12 lakhs, 12 lakhs divided by 1,200. 12 lakhs divided by 1,200. How many Nifties here? 1,000 Nifties. Number of Nifties is 1,000 Nifties. Please. It's going to be 1,000 Nifties. Yes or no? Now, I have to deal in Nifties and Nifty contracts. Nifty contracts. Since one Nifty contract is equal to, presently how many Nifties? 100 Nifties. Since one Nifty contract is equal to 100 Nifties, since one Nifty contract is equal to 100 Nifties, the number of contracts is equal to, tell me the number of contracts is equal to what divided by what? 1,000 divided by 100. How many contracts? Number of contracts is equal to 10 contracts. The number of contracts is 10 contracts. Everybody, are you following or not? Now, point number 3 or 4? 4. The strategy is, point number 4, the strategy is buy, the strategy is what? Buy 10 Nifty futures contracts. The strategy is buy 10 Nifty futures contracts. Buy 10 Nifty futures contract at what price? 1,200. Buy 10 Nifty futures contracts at 1,200. Buy 10 Nifty futures contract at 1,200. Up to this, you have the clarity or not? Now, point number 5. Point number 5. When the market price increases, two situations the question arises now. Now, point number 5. When the market price increases. Why the price has increased? America has lifted what? Sanctions. So the market price increases. Tell me, I am having my legs in how many markets? 2 markets. Write down. What are 2 markets? Cash market and then what? Futures market. I have my position in 2 markets, cash market and then futures market. Can I proceed up? No. Cash market, now I have sold or purchased or sold. I have a sell Tata Steel at how much rupees? 150. In futures, I have what? Bought. I am having a buy Nifty futures at 1,200. The Tata Steel price decrease or increase or increase. Now I have to buy back at how much rupees here? 154. The price increased by 4, 154. Tell me in the cash market, profit or loss? Loss. Loss how much rupees? 4 rupees. Into how many share? 10,000 share. The loss is how much? 40,000. Buy futures given a counter, sell. I sold at a lower nifty, a higher nifty, a higher nifty. Then what was the nifty profit? 1,275. Counter sell 1,275. Profit or loss? Profit. What profit per nifty? 75. Into how many nifties? 100 nifty. Into how many contracts? 10 contracts. Respond yes or no. Tell me what is the number here? 75,000. Overall, I have a profit or loss? Profit. The overall profit is how much base here? 35,000. The overall profit is 35,000. The answer is 35,000. Everybody, are you understanding it or not? Now, next. Point number 5 or 6? 6. When the market price decreases. When market price decreases. When the market price decreases. Everybody, shall I start them? No. I am having my legs in how many markets? Two markets. Cash market, futures market. Cash, I have taken a short or long portion or short portion. I have sold the Tata Steel share how much? 150. Futures, I took a buy futures or a long portion. How much base? 1,200. I closed by buying the share when the market was down at how much base? 135. What the profit I made? 15. Into how much? 10,000 shares. Is it how much base? 1,50,000. Futures buy is given what? A counter sell. I sold how much base? 1,150. The loss is how much per nifty? 50. Into how many nifties? 100 nifties. Into how many contracts? 10 contracts. What the loss amount? 50,000. Overall, I had a profit of 1 lakh. Had a profit of 1 lakh. The overall profit is 1 lakh rupees. Everybody understanding it or not? With this, we have completed the solution to this particular question number 33. Are you all following? Okay. Now, 32 over, question number 33 over. Question number 34. Just we'll orally discuss and then leave it for you to do on your own. Can I say it? Now, identify the hedging strategy, please. That would be required using the index futures under the following circumstances. Now, you tell me the answer. The stock is what? Reliance. The position is long. Long means what? Buy. Number of shares is 1,000. The price is 500. Now, tell me, 1,000 into 500. What is the number? What is the number here? 5 lakh. In cash market, I am long 5 lakhs. Yes or no? I want to hedge using what? Index. I mean, how much beta? 1.2. In futures market, I should go long or short or short. I go long or short? Short. Short by 5 lakhs or more than that? More than that. Beta times cash market value. 1.2 into 5 lakhs. Enough is. How much base is 6 lakh. Now can tell me the strategy? No need to write. What is the strategy here? Sell index futures. What? How much base here? 6 lakh. Is the answer. Enough are you following us? Please tell me yes or no. Now. Next. Satyam. Okay. That's Satyam. Can I say? No. Irpurpose. I am holding. I am long what? Satyam shares. How many shares? 1,000 at 350. What is my cash market value? 3,50,000. I want to do what hedging? Full hedging. Futures market. What should be the value? 0.8 into 3,50,000. Sollupa number. 3 lakhs? 2,80,000. I should go long or short or short. Short nifty futures. What how much the base? 2,80,000 is the answer for the second question. Third. Reliance, I have sold the purchaser, sold. I am short in cash market for how much here? 5 lakhs. Yes or no? In futures, I have to short or long or long. Go long futures, how much here? 6 lakhs. 1.2 times of 5 lakhs. Yes or no? No. Tell me next. Satyam, I am short 0.8. I am just what? Short 1,000 at 500. What is the short portion? 5 lakh. I am 5 lakhs having short portion in Satyam. Yes or no? Now, tell me. hedge needed is 100% hedge needed or 80% or 80%. Yes or no? That means my beta should be reduced by 80%. In the case of multiply by the full beta by 80%. How going to be 80%? Yes or no? That is, my target beta is 0.2. Or you'll follow what I'm saying? In that case, what should be the hedge ratio? It is 5 lakhs into 0.8 into 80%. 0.64. Did you understand? Or repeat? Now, I'll repeat. See, again, listen here. I want to hedge not fully, only by what? 80%. That means my risk should reduce by how much percent? 80%. What should be left with is only what? 20%. Very simple, yeah? 0.8 is the current beta, so no? What is 20% of 0.8? Suluba? 0.16. My current beta is 0.8. My target beta is what? 0.16, because I don't want to hedge fully. I want to hedge only by how much percent? 80%. So what is the reduction in beta required here? 0.64. 0.64 times 5 lakhs should be what? The position required. Now, I am short in cash market. What should you do? Go long in futures market. Everybody having the clarity, yeah? Yes or no? Last, everybody tell me, what is my hedge needed? The hedge needed is what? 120%. It should be what? 120%. In that case, I should take what? Similar portion in the other market also. Everybody following or not? Now, all this, can you write down your own or not? Now, just a primitive question or introduction problem only. We have done a detailed problems in other way around. Can I proceed? Now, with this, we complete this chapter, futures. I have to do one sum. I will do it later. Before I completed, you clapped. I have not done all sums now. Now, question number 13. I think I have not done question number 13. I'll do along with the currency futures later. 13 alone has not been done. All the other problems has been completed. Please. Don't talk. With that, we have completed the chapter futures. Just to check. 1, 2, 3, 4, 5 done. Yes or no? 6 are given as Omar. Those are done. Question number 6. Raise your hand. At least happy few did it. Okay. Done question number 6. 6 are not? No. Nappa. Class la. It's so much. Not even 1%. Yeah. Not even one. Left tail. Left tail is at least 1%. So normal. So no. No. Okay. I hope you all do question number 6. Not well left. Okay. Now. 7 is nothing but reading quotation. Instead of gold, I showed you TCS futures and read the quotation for you. You can understand this CMX gold futures quotation. 8 we did open interest. 9, 10, 11, 12 we did. 13 will do later. 14 has been what? Completed. 15 completed. 16, 17, 18, 19 all are completed. I think 20, 21 done. 22 and 23. 24 all the 3 are done. 25, 26, 27, 28, 29, 30, 31, 32. Given 34 has been what? Discussed. Given us what? Homework. Shh. With this, we have completed this chapter, futures except for one problem. Okay. Now.